Now live, so I'll make on start, and if anyone's late joining, I'm sure they'll just catch up as we go along. So good afternoon, everyone. Thanks for joining this afternoon session. My name is James Randall. I am an Associate Director at IPM SIPP Administration. And as you'd already know from signing up for this webinar, what we're going to be doing today is talking a little bit more about commercial property in SIPPs. And the areas which we think you guys need to be aware of. Obviously, given you're members of the Commercial Property Network, you guys have extensive knowledge on commercial property. And there's going to be nothing here today that I'm going to teach you on that, I doubt. But if you're in the commercial property industry, there is no doubt that you've also probably come across the term SIPP or self-invested pension at some point along the line. So the idea today is to talk to you about that asset class from a SIPP provider's perspective, to let you know the things that we look out for. So to maybe just give you extra knowledge in your toolkit for when you're talking to your clients and professional connections about this area. It's just a little bit of background as to why I am the one that's sitting in front of you today. Samantha Johnson from Brickley Holman and I connected on LinkedIn some time ago now, talk about ways that we could work together and benefit each other. I know Samantha has done a lot of work in the SIPP space for the network over the years. And so we just thought it might be a good idea just to kind of me come on today and talk to you a little bit about the work we do here at IPM. So as I say, hopefully some of this stuff will be new to you and be beneficial. If not, it'll just reaffirm any understanding that you guys already have. So to go through a brief idea of what we're talking about today, we're going to look a little bit about IPMR. This isn't meant to be a hard sell of IPM by any stretch of the imagination, but at the same time, I think it's important you understand our business, what we do, and so you understand where we're coming from in terms of this presentation. And I'm not sure where everyone's knowledge base is at with SIPPs, so I always think start low and then go high, right? So we're going to be looking at the very basic details of what a SIPP is. And if you've used the word SIPP before, I'm sure you've heard the word SaaS. So we'll look at that in a very little detail as well. From the SIPP provider's perspective and from a client's SIPP perspective, we'll look at the reasons why you should and shouldn't buy commercial property within a SIPP. Before looking at some of the specifics that HMRC place on SIPP providers in relation to commercial property investment in the pension scheme. We'll then look at examples of properties that IPM have bought for clients. I don't expect any of the properties I show you to be rocket science to you guys, but there'll be some stories behind those, like mini case studies, to kind of understand where clients use pensions and commercial property together, which might make you think about some of the people you guys work with. And then we'll briefly look as to where IPM can help you guys on the network. Where can we help you on a day-to-day basis? What's the kind of thing that we do that's going to add value to your work? Questions and discussions at the end. I'm aware that Leslie is recording and watching this presentation. She is going to be monitoring the questions, and she said that she will be putting some questions together at the end. So I will take those at that point, and hopefully if there are any, just pop them in the chat and we will go from there. Right, let's move on. So no doubt when you saw the invitation come to join this presentation, there's going to be some guy from IPM talking about SIPPs and properties, you'd probably be thinking, well, who the heck are IPM? I wouldn't blame you for that either. We're not the most brand aware SIPP provider out there. We're certainly not AJ Bell in terms of the size or client numbers, but we're very experienced. We were first established in 1999. Our scheme was an old merchant bank pension scheme. And in 99, they sold their banking license to another bank. But the bank also had 300 SIPP clients and about 60 million of assets at the time. They wanted a quick sale. And it was at that point that the guys that ran the scheme for the bank turned around and said that we'll be out your hair by next week and we'll take all the desks and everything else with us at the same time. And that's how IPM started. The guys who worked at the bank running the pension scheme founded IPM in November 99. So we moved out of London at that point and moved to our location in Hertfordshire, where we're based now. And 25 years on, we have something in the region of 5,200 clients and about 3 billion of assets within our scheme. That is putting us in kind of like the top 10 SIPP providers in the UK, if you knock out all those insurance company SIPPs, which aren't really SIPPs at all, but we'll get into that a little bit later on. Some important points about who we are, which will help your understanding of our business. We're still a privately owned company, so we're not part of a massive conglomerate, and we've got no massive parent company backing us or anything along those lines. We are a privately owned company with shareholders within the business, and all we do is concentrate and provide a SIPP administration service, and that is it. There's a succession plan within the business for people like myself who have been involved for 20 years plus in IPM to carry on the business going forward. So from our perspective, there is just that sole laser focus on providing SIPP administration. And the only kind of SIPP offering that we have is a bespoke SIPP, which is a full bespoke SIPP, which allows a full range of investment opportunities. Again, we'll talk about the different types of SIPPs in a moment, but what that means is that we allow things like commercial property. So we don't have like just an online SIPP or a single investment SIPP or anything like that. Our SIPP allows a full range of investment options. So that means that clients, alongside holding commercial property, often have like platform accounts or maybe a discretionary fund manager or cash management solutions. It offers that kind of full flexibility. And whilst I'm absolutely not here to kind of punt our SIPP to you guys from that perspective, we do charge a flat annual fee of £580 plus VAT as a fee for the work that we do, and that's just to kind of give you an idea of the kind of clients that we would work with. So we're very much not, a couple £100 a month being saved and put into a fund. We're talking about those clients with high net worth portfolios, or those clients that need the sophistication of a full bespoke SIPP to do things like buying commercial property. We are regulated by the Financial Conduct Authority to provide SIPPs only, but we can't provide financial advice. So in case compliance are watching this, I do have to say at this point that anything in this presentation is just information only. It should not be received as advice. Primarily, IPM promote ourselves to financial advisors and advice to their clients regarding suitability of IPM as a SIPP provider, suitability of pension transfers, contributions, and suitability investments too. We do have mechanics for dealing with clients that approach us directly, but it probably is around 5% of the total number of clients we take on board a year. And considering we take on about 300 to 400 clients a year only, it's not a high number, but we do have those mechanics in place. Like most firms out there, we think we do a pretty good job, but we're also got some third-party accreditation to back that up. We're AKG rated for financial strength, which is a big thing for financial advisors these days, especially post-consumer duty in the financial industry world. We also got 5-star ratings by De Facto, but we've also been 5-star rated by Moneyfacts in the last 9 years, which is a great credit to our team here. And kind of talking about the work that we do, we are kind of specialists in the areas of commercial property within SIPPs. It's a big part of what we do. We own over 1,200 properties on behalf of our clients. So if you think we've got around 5,200, that's a significant weight of our clients that have an involvement in commercial property, especially if you think that more than one SIPP will have an involvement in a particular commercial property on a group SIPP basis or something like that. And in 2024, around 58% of the new SIPPs we established had some sort of involvement in commercial property. So it's a big part of what we do. We employ a specialist team at IPM who deal with property transactions day in, day out, and that makes up over a third of our entire staff list. And a member of that team is allocated to each individual transaction. So that gives you and your client a point of contact from instruction through to completion and beyond. We're not a massive insurance company. We've got one office. We're based in Hertfordshire. There's 36 of us. This is all we do day in, day out. We pride ourselves in providing a bit more personalized service than sometimes you get against those bigger providers who do offer the bespoke SIPP offering, but actually it's probably not their main focus like ours. And commercial property pricing wise, we are one of the most competitive in the market for SIPP operators. I won't go into too much detail, but the main difference with us is we don't charge an annual property fee on top of the annual administration fee your client's already paying. And that can save clients significant amounts of money over the years, especially if you think that the property is held as a long-term asset and the property could be in a SIPP for 20 or so years. Anyway, that's enough about us. And I'm happy to answer any questions about IPM off this chat at any time, or if you want to know more about how we work, we can do that separately and individually. Right, let's get into the meat of it. So as I said at the beginning, I wasn't quite sure where you guys sat with SIPs in terms of your knowledge base of it. So again, if I am talking about stuff you already know, forgive me, but it might be a nice refresher for you. But I thought I'd go with the basics of what a SIP is. The ability to self-invest pensions is actually something that was around in the late 70s, but it was more related to occupational schemes. Occupational schemes are those that are linked to a company. But it was in the 1989 budget when that flexibility was extended out to personal pensions. So traditionally, personal pensions were run by like insurance companies, and you could select from a number of funds. What the idea of self-invested pension, the SIPP, was in '89 was to give people greater flexibility and control over their retirement savings. And that kind of then stemmed into being able to do things like buying commercial property. And so the SIPP was effectively born at that point. And what a SIPP is just a personal pension scheme, but it's normally run by a trustee and operator of the scheme, someone like IPM. So our role here is to operate the scheme on a daily basis. So for example, we would do things like complete the HMRC annual return for each client and claim tax relief on pension contributions and all those kind of things. Whereas typically when you've got other types of schemes, sometimes the clients have those responsibilities as well. But a master trust such as IPM would take on those roles on a day-to-day basis. And no doubt you guys might be familiar with SIPs. You might have a SIP yourself. You may be aware there are a wide variety of SIPs in the marketplace. I first joined IPM in 2002, and the market was quite small then. It was more traditional bespoke providers. But now lots of insurance companies, investment houses have their own SIP, but those SIPs will only allow a very small selection of investments. So if you take the Hargreaves Lansdown SIP, for example, works very well, but you can only invest on the Hargreaves Lansdown platform and whatever that platform will allow you to invest in. AJ Bell, as I said, one of the best SIP providers in the UK, in my opinion, but in the last 3 or 4 years, they turned around and said, we're not going to allow commercial property within our SIP anymore. It's going to be mainly platform-based investments. So the restriction of what that SIP can invest in has been reduced. And so when we're talking about bespoke SIP providers, those are those providers which allow a wider range of assets like commercial property. So in our sphere, the kind of competitors that we have in the market would be firms that might be familiar to you like Denton's, XBS, Barnett Waddingham, Investstack. You know, these are all guys that are very similar to us, provide a tailored service to their clients and allows things like commercial property purchase within it as a full investment option. So to say, there are a wide variety of SIP providers out there. We all kind of do the same thing, but the difference you'll find, like in most industries, is there's a different in price and a different in service standards. So when you're looking to work with SIP providers, you'll probably get a gauge of both of those as well. And from that point, as I say, you know, you can consider which provider will be best for you or your client. When we're talking about SIPs, you can't really talk about commercial property within SIPs without talking about SASs. So SASs predated SIPs. These were the old occupational schemes, because a SAS is a small self-administered scheme. So whereas the IPM scheme is just one scheme, and then we have 5,000 odd clients in it, and they each have their own individual segmented arrangement within that scheme, a SAS is a specifically registered scheme for a particular group of clients. And it's normally linked to a company, so a limited company with directors and spouses. There might be like say 4 or 5 people that set up a SAS. They're all the senior partners or senior directors of the company. They all bring their money in, and then they look to buy a commercial property within that SAS arrangement. Now, SIPP and SAS are both actually regulated under the same legislation, the Finance Act 2004. So the reality is there isn't really much benefit of having one over the other from a tax or a planning perspective. The main difference between SIPP or SAS is the practicalities of dealing with them on a day-to-day basis. So with the SIPP, as I mentioned earlier, IPM are the trustee and operator of that scheme. So ultimately, we will sign the lease, we will sign the TR1, we will transfer the money to solicitors upon completion of a commercial property purchase. We will do that, but we won't do it without an instruction from the client. So that can allow for speed, especially when transactions become a little bit protracted towards the end. It allows us to get things done relatively quickly. But with the SAS, there is a professional trustee that sits in the background like IPM, but actually it's the clients who are managing the SaaS on a day-to-day basis. So they're the ones that need to sign the forms. They're the ones who need to complete the leases. They're the ones who need to action the bank transfers and also do all those other bits like scheme returns, tax relief free claims, and doing VAT returns on VAT registration. So I think that there is a perception that, that SaaSes are a little bit outdated, but actually they do provide a good solution for those clients who want to be hands-on. While SIPPs are more mainstream and the majority of people will go for SIPPs, they can allow for probably a bit more cost effective in some instances, and they can also give a little bit more streamlined approach to when buying commercial property. The other main difference with SaaS is they're not regulated by the FCA. SIPPs have been regulated by the FCA since 2007, and there's overwhelmingly been a positive thing. But what the FCA had is certain type of regulations over investments. So SaaSes, for example, can invest in things like can invest in things like unquoted shares, or they can invest in things like connected loans and things like that, whereas a SIPP can't do that under FCA regulations. So as I say, if you're talking about SIPP or SaaS, the legislation around them are both exactly the same. It's actually just the practicalities of how they work which are different. But as I say, both can invest in commercial property and both have broadly the same benefits. Right. Let's move on to why commercial property is as an investment within the SIPP. As I said earlier, I've been at IPM since 2002, and we have been buying commercial property ever since I've been here. I talked to our property team last week when we were having our catch up, and they informed me we have 93 transactions going on at the moment, whether that be a purchase or a sale. It's something I talk to financial advisors about predominantly on a day-to-day basis. And like any property transaction, there are loads of hurdles that go in the way before we actually get to a point where we're setting up a SIPP and instructing solicitors, So actually from that perspective, it's a conversation we're having a lot. But if you actually think about what a pension scheme is for, right, it's here to provide a client with long-term retirement benefits. And I think actually a commercial property as an investment choice for a SIPP can actually work out to be quite a good one. If you buy a property today, and I'm sure there's many people on this call that will be able to hopefully back me up on this, if you buy a property today, in 20 years' time, there's a pretty good chance that that property is going to be worth significantly more money. So for a SIPP, you want long-term asset growth. Well, the property is going to do that. And again, with a property investment, you want a good yield, right? So, obviously, the markets have been all over the place over the last few months since Mr. Trump has got in. But if you've got a 5-year lease paying a 7, 8, 10% rental yield on the property, that's a great return for a pension fund, especially if someone's taking drawdown or taking income from their pension. They've got that rent coming in, which then allows them to receive that income. So as a pension scheme investment, good asset growth, good return, it kind of ticks a couple of boxes there. But where I think it all dovetails quite nicely is the tax efficiencies of a SIPP. So again, you guys may or may not be familiar with the tax benefits of pension schemes, but when you pay contributions, there is usually tax relief. If you pay it out of your personal salary, you get tax relief for your highest marginal rate. Your SIPP provider will reclaim 20%, and if you're a higher rate taxpayer, you can claim the rest directly back from HMRC. If you make a payment from a limited company as a contribution, it's not eligible for corporation tax relief. So you can save benefits there. You can save some tax there as well. This is also restricted to certain allowances. But if we think back to the actual commercial property, that property that we bought and in 20 years' time we come to sell, there's no capital gains tax on disposal of that asset. All that rent that's coming in as a return for the pension fund, there's no income tax to pay on that. So from that perspective, you're getting income tax-free money coming into the SIPP. Even neater, if the client's business premises are the ones that are held in the scheme, they have to pay rent to the SIPP at market value. And so that rent is paid from the company, corporation tax deductible from the business, into the SIPP being received income tax-free. And it doesn't count towards the contribution allowances as well, because this is investment return as opposed to making new contributions to a SIPP. So some of the tax perspective there is good. And if a property is VAT registered, we're able to opt the SIPP for tax to reclaim the tax back from the VAT back from HMRC on the purchase price. And if you're buying a property worth $500,000 plus VAT, That's a significant amount of money. So yes, a good investment choice for a pension for long-term asset growth and good return, but also the tax benefits of holding assets in the pension scheme really dovetail nicely, in my opinion anyway, for holding property within a SIPP. No doubt you guys will be familiar with borrowing for commercial property. When it comes to borrowing within a SIPP, there are slightly different criteria to consider. HMRC imposed a limit of 50% of net scheme assets that a SIPP can borrow. Well, that's just a real complicated way of saying you can borrow half of your SIPP's value. So if you have £300,000 in a SIPP in cash, you can borrow up to £150,000 in order to give you a buying power in this instance of £450. And so that got £50,000. So that, again, from that perspective, banks tend to be a little bit more willing to lend to SIPP providers in our experience once they understand what a SIPP is, because sometimes that can be a little hurdle. Because the loan to value is not so high, there's not so much risk involved. You guys might be used to dealing with loan to value on a 90%, 80% loan to value ratio. For us as a SIPP provider, we're not too fussed about that. We just need to make sure that we can borrow up to 50% of the net scheme assets. We can't go over that. And that would include the VAT as well. There's no ability to bridge the VAT, even though we can reclaim that within 10 to 12 weeks usually. We can't bridge that over the 50%, so any VAT would need to be included in that as well. And over the years, we've seen many practical ways of how people have used commercial property and SIPPs together to benefit themselves and their businesses. You know, again, as I said earlier, we are here predominantly to provide clients with retirement benefits, okay? But actually, you know, a very common scenario we deal with is that, say, for example, a client's business owns a property worth £150,000. And they have a pension pot already built up from accumulation of funds over the years of £200,000. They can consolidate all those pensions into a SIPP, say with IPM. So you've got £200,000 sitting in cash, you've got £150,000 property sitting in the business. You sell that property, £150,000 into the SIPP, goes the property, and out of the SIPP comes £150,000 and goes straight into their company bank account. Now, obviously there'll be tax implications there, and we're not accountants or tax experts in that respect. But what that is a way of doing is releasing capital from a pension scheme in a way that is not the usual 25% tax-free lump sum or taking income along those lines. You know, this is actually a way of kind of getting the money out of the pension scheme, but also the SIPP acquiring an asset as well. So as I say, there are ways that people are using the SIPPs more effectively than maybe they've done previously, and the commercial property angle is a good way of doing that. Now, I felt that I would need to strike some balance here, so I needed to find some negatives of doing commercial property purchase in the pension scheme. Now, I had to dig deep to find some, but I found 3 on the right-hand side here. And I'm going to take the first 2, excuse me, on the first 2 on the right-hand side here as together. So lack of liquidity and lack of diversification. You know, as we keep on saying, SIPPs are here predominantly to provide clients with retirement benefits, right? So if you're going to buy a commercial property, the advisor and the client really need to be thinking about when are they going to be needing to use those benefits in the SIPP to provide the client either with their 25% tax-free lump sum or pension commencement lump sum, to give it its full name, and any ongoing income. So, you know, with the costs involved in acquiring a commercial property, you know, is it the right thing for someone to do to put in a vast majority of their SIPP into a commercial property if they're going to want to take 25% of their tax-free lump sum from their SIPP at some point in the very near future, say in 2 or 3 years' time? You know, if people are invested in a stocks and shares portfolio, it's pretty easy to liquidate 25% of that to pay them their tax-free lump sum. If it's a commercial property, it's a little bit harder to liquidate that 25%. And diversification, you know, all your eggs in one basket. A lot of the SIPPs that we have, the overwhelming asset within that is the commercial property. And so if you've got the commercial property sitting in the SIPP, and that is by far your largest asset, and you've planned to take your benefits from your SIPP, sell the property, and then take your benefits at a certain point, and the commercial property market crashes and it goes down by 30–40%, then, you know, your client is going to have a big impact on the amount of fees that they're able, on the amount of tax-free lump sum they're going to be able to take from that. So liquidity and diversification are 2 to consider. But I think the biggest negative, and I think this is a real point for you guys to consider, is the fact that it is the pension scheme that owns the property, right? It's not the client. The client are the beneficiaries to the SIPP, but the SIPP trustee is the legal owner of the property. And in exchange for all those tax benefits that we talked about earlier on, there are a set of guidelines issued by HMRC. And notice I say they're guidelines, right? They're not rules, because guidelines could be open to interpretation. And so that is why, if you've ever spoken to one SIPP provider and you've asked them a question and you got one answer, and you spoke to another SIPP provider and you got another answer, is because they're interpreting the rules in a different way. We talked about AJ Bell a little earlier on. You know, HMRC guidelines say that you can buy commercial property in a SIPP. Doesn't mean a SIPP provider has to do it. So AJ Bell turned around and said, this doesn't fit with our business plan. We're not going to do commercial property anymore. You know, there was another very well-known insurance company SIPP provider who allows commercial property purchase. This was some time ago now, but they turned around overnight and said, we think borrowing in pensions is too risky. We're not going to allow it anymore when you're buying a property. So if you've gone with that SIPP provider for your client and you're going to do borrowing in a commercial property transaction, you just had the rug pulled from underneath you overnight. So I think the first port of call is to talk to clients about the fact that, yes, you can get, there's lots of benefits. Yes, there's lots of advantages of doing this kind of work, but especially when people are selling a property they may own within their business or personally to the pension scheme to release that liquidity like we talked about, you know, they will have to give up some sort of element of control, you know, and we'll talk about some of those in a moment when we talk about the things to consider. But what I'd say is that if clients are going to go down this route and you do choose to go down the SIPP route, it's important to work with a provider that can work with you, you know, not ones that you don't kind of have a relationship with, not ones you can't pick up the phone and have a discussion with. You know, buying property is emotive. You guys will know that more than me, right? There's a lot of things that go into it and there's a lot of stress towards the end of these transactions. What you don't want is a non-responsive SIPP provider sitting in the middle of that hole. So work with the SIPP provider who you choose to work with. I can only speak from our experience. You know, we speak to advisors day in, day out about potential transactions. You know, we'll sit there and go through the scenario to hand and we'll try and plan it out as best as we can. And when things go wrong, because invariably they do, we all try and work together to try and get that resolved. So as I say, it's not necessarily a negative to work with a SIPP provider on that basis, but what I would say is the first conversation you have with clients about this is that, yes, this could work for you, but you are no longer going to be the legal owner of the asset. The SIPP provider will be. And as such, the SIPP provider will be looking out for the pension scheme in the first instance and will be working with HMRC guidelines as well. So where can HMRC trip you up? What are the things which you will need to think about for SIPP transactions, which you wouldn't necessarily need to think of for other transactions you guys may get involved in? So we've got these specific SIPP issues around property purchase, which I thought we'd look at. And again, these are all based on the guidelines from HMRC. Some are open to interpretation, which we'll go through, but some are very clear cut. Although they're guidelines, they are kind of like rules because they do actually specify what you're supposed to do. Other aspects of it, you know, they're a bit grey. And so each SIPP provider will take their own views. So we'll try and talk about that in a little bit more details. But when I was preparing this presentation, these 5, I think, are ones for you guys to bear in mind. Let's deal with connected transactions first of all. So by connected transactions, what I mean in my SIPP world is that the SIPP beneficiary, so whoever the SIPP client is connected to the property in some way. So this could be we are buying a property from someone who is connected to the SIPP client. That could be the client personally, their spouse, a business of which they're a director of. We could be selling to one of the same parties. Or we could be granting a lease to the client's business. They would be connected by the same definition. Where there is a connected transaction, HMRC are very clear that all transactions must be carried out based on commercial values. So for example, if a property is valued £200,000 and we are buying it from the client's business, the SIPP provider must pay £200,000 or whatever the figure is specified in the valuation report issued by the client's surveyor. We cannot pay a pound over, we cannot pay a pound less. The reason for that is that if we underpay, say for example, we pay 180 in this instance, then the client's getting a higher value asset in the pension scheme, which is obviously tax protected, no capital gains tax on disposal, all that kind of stuff. So actually, they're very keen to ensure that doesn't happen. And likewise, if the property is worth 200,000, we can't be going to paying 250,000 pounds for it, because you're getting more money out of the pension scheme than you would do otherwise. Where there's unconnected transactions, we do have a bit more flexibility. We have our internal tolerance here. So, for example, we still look at it as a trustee, as we're looking at the investment of pension scheme money. So, even though the client might see a property worth £300,000 and they think this would be perfect for my business because of something, and they want to overpay, they want to pay £400,000 for it, we as a trustee would turn back and go, well, hang on, why would we pay £100,000 more in this instance for a property we could get for 300,000? It doesn't make sense. It's not a good investment decision. It might be the right thing for your business, but as trustees, we're always looking out for the best thing for the pension fund. And also, if a client is if the client's business is occupying the property, they must pay market value rent as specified by the surveyor. And again, there is no wriggle room with that. If the annual rent is £20,000, that is what the business must pay to the SIPP to occupy the premises. We have a little bit more trickiness, if that's the right word, with connected tenants when it comes to things like rent-free periods and things like that. Whereas we could make a commercial decision on an unconnected tenant, say if they need 3 months rent-free for whatever reason, then we can maybe look to do that. But with a connected tenant, it's a lot harder to justify to HMRC why that should take place. So connected transactions aren't really an issue at all from our perspective. There's just certain things you need to think about which are different to unconnected transactions within the SIPP. VAT registered properties is the next bullet point. We probably 1 in 4 properties we buy are VAT registered. Doesn't cause us a problem. We have to register the SIPP for VAT with HMRC, and then we have to reclaim the VAT on the purchase price once that's done, which is obviously a good thing for the SIPP, because we get the 20% value of the property back in cash. And then we also have to do the quarterly VAT returns as well. So the SIPP provider, as being the legal owner of the property, we would complete, in IPM's instance, complete the quarterly VAT returns, and we would pay VAT that's collected on the rent off to HMRC on a quarterly basis. So again, not an issue. We can absolutely deal with that, but it's just an extra consideration, something extra to think about. And the main thing with VAT registered properties is we have to opt to SIPP to tax, so send off the VAT forms to HMRC, and that can take a period of time to come back. During COVID, we were looking at multiples of months, approaching 6 to get that back. We're now down to probably around 3 to 6 weeks on average. So again, not an issue, but if you've got a speedy transaction that needs doing, that could potentially trip you up. Coming on to more of the grey areas now, works on commercial property. So your client might want to buy a property within a SIPP that needs some work carrying out. Now, this is, again, these are more guidelines from HMRC, so it's open to interpretation. I'll speak to you about how we view it, how we see it. So there are 2 types of works and how we view it. One are works that have an impact on the value of the property. So for example, that could be a new roof, it could be knocking down some walls, it could be an extension, something like that. Others are going to be decorative. So that could be, new carpets, a lick of paint, something like that, maybe new broadband. Now, where works are going to be carried out on a property that are going to affect the value of the property, that property is an asset of the pension scheme, so it's an asset of the SIPP. So the SIPP will need to pay for that, okay? So if, for example, you want to put a new roof on, and I don't know how much a new roof costs, so let's say it's £50,000. So say the roof is going to cost £50,000. The client can't pay for that personally. The tenant can't pay for that. The SIPP must pay for that because the property is the property is owned by the SIPP. And so coming back to the fact that it's IPM as the trustee that owns the property, because we are the trustee, we're going to look at that. Okay, right, £50,000 is what we've got to pay for this roof, but that is the investment of pension scheme monies. So actually, why should we do this? And so we want to understand that if we're paying £50,000 for this roof, then actually the value of the property, the asset of the pension scheme, is going to increase by a similar amount. So there are some considerations to be given there, and anything such as decorative or upkeep, maintenance, repair, we would put in place a fully repairing, insuring lease, and we would expect the tenant to take care of the property on a day-to-day basis. But we have had problems before where things are just been done without the SIPP provider's knowledge, without our knowledge, and it causes problems further down the line because HMRC might see that as a pseudo contribution to the pension scheme. So what I always say, with any work that needs to be done, always engage with the SIPP provider. We're very happy to kind of give you a steer and work together, but I'd rather deal with problems before they arise than trying to deal with the aftermath, prevention rather than cure and all that. Residential property, another fabulous grey area within SIPPs. HMRC's definition in their guidelines is residential property is somewhere suitable for a dwelling. That is it. So from that perspective, that is why SIPP providers have very different views on what will be considered residential property. Residential property, in case you don't know, is a pretty bad thing for SIPPs. You get a tax charge starting at 40%, can go all the way up to 70%. No SIPP provider is going to let you buy a house, right? So there's the first instance. But actually, some property types might skirt a little bit between the two. So, you know, the no's from us. So if you came to us with student accommodation, Airbnbs, holiday lodges, villas, all that kind of thing, no, we're not going to buy that at all. But other SIPP providers may take a different view. You know, we struggle with some certain types of B&Bs as well. Commercial hotels where there's a reception and a kitchen and a bar and all that kind of stuff, we're more open to that. But actual you know, houses where people rent their rooms out and stuff like that, that's just a bit too sketchy for us. That's going to get too close to sailing towards the wind of what HMRC deem as suitable for a dwelling. And there's also some consideration for properties that convert from commercial usage to residential usage. We can look at those on occasion, but we don't want to be owning a property that's being converted into residential while it's still owned within the SIPP. So again, residential property should be a little bit of a warning sign for you guys when talking about SIPPs, but it doesn't always necessarily mean there's an issue. It just means it needs more consideration. Talking of further consideration, last bullet point is land purchases. Land purchases are ones we're asked to consider on a regular basis, and they can be okay, but there's just further consideration for land than there is when buying traditional bricks and mortar. HMRC want any investment that we make to be genuinely commercial. So if you're buying a shop, that's fairly easy. If you've got Costa or Ladbrokes in as a tenant, you know, there's a genuine commercial thing going on there. You've got a tenant paying rent, etc. But with a plot of land, commerciality can sometimes be a bit more difficult to define. Typically, we would buy land for people like farmers, so they then lease the farm, they lease the land for their farm for cattle or for growing crops. We may look to do things like have telephone masts or wind turbines on the land, but we don't actually own the machinery. We just own the land and rent it to whoever owns the mast or the wind turbine in that instance. And then there's things like, you know, equestrians, barns, stables, fields, you know, people that have gallops and stuff for horses. So things like that are going to be more acceptable. But if you're looking, yeah, we've also been asked in the past to buy plots of land opposite someone's house. And the reason they wanted to buy it was because they didn't want anyone to build on it, so it sport their view over the valley or whatever it was. So, you know, things like that we can't do. So a little checklist for us is that we will consider land as long as we've got access to a public highway, so it's not landlocked, because who wants to buy landlocked land? You know, what's the future saleability for the SIPP to get market value in the future if it's landlocked? Has to have genuine commercial interest. So, like, as I say, is it a stables? Is it a farm with crops growing on, stuff like that? Dog walking businesses have suddenly become popular, so you have a field which the dogs can go into, and that, you know, that's genuine commercial as well. And also, it can't be anywhere near the client's residential property. It could fall into that trap of HMRC tax charges. And again, we have had people try to buy plots of land at the bottom of their gardens so they can store their classic cars on there, which is going to be a no. So these are all things which are very specific to SIPPs, and I've just whistled through those without that much detail. In each of these scenarios, there would be more to consider and look at, and these are the kind of things we can support you guys with. So again, this is why it's important to speak to whichever SIPP provider you choose to work with, because things like the connected transactions or maybe the land purchases, there's specifics there that could trip you up, and it's better to deal with these things before rather than try and deal with it afterwards. Okay, we're coming on towards the last couple of slides now, because I just want to keep some time for questions at the end. I wanted to give a little bit of an overview on some of the properties we bought and give you some of the stories behind it to kind of make you think a little bit more about how the SIPs are structured and what the people's thinking are behind setting up SIPs and buying certain types of commercial property. And when I kind of put this slide up normally where it says what types of property can be purchased by a pension, I often think, well, you guys might think, well, that's fairly easy, you can buy commercial property. But as you guys will know, that is such a broad description. Our starting point at IPM is we will consider any commercial property within the UK, as long as it's on a freehold or long-term leasehold basis title. That is it. So as long as it fits that very broad description, we will consider it. And just something else to drop into about HMRC guidelines, I just said that IPM won't buy commercial property that is outside, IPM won't buy commercial property outside of the UK. That is our decision. HMRC will allow you to buy commercial property anywhere in the world. And when these rules came in that you could buy overseas commercial property in 2006, we thought, well, do you know what, we'll give it a go. And so our first inquiry came along and someone wanted to buy a Portuguese warehouse, which all sounded okay, until we quickly realized we don't speak Portuguese, the other side don't speak English, and Portugal try and apply commercial property taxes on all properties held over a tax exempt scheme, and they didn't understand UK trust law. So it fell flat pretty early on. So we won't do overseas property, we'll just look at UK only. So I'll quickly go through these different scenarios and talk to you a little bit about the stories behind them. If we take, I'm going to go from the top left and work my way across. So if we take the top left, the one looks like a row of houses. I can assure you, or Google tells me, that is not a row of houses. That picture is supposed to represent a barrister's chambers in London. It's the biggest group of clients that we have who collectively own the chambers within their SIPs. So we have over 30 clients who have individual SIPs with IPM, and collectively part of their SIPs each own the chambers from which they work. They're all barristers of the chambers. Group property purchase is not unusual. We have been doing this ever since we set up IPM in 1999. But typically, the kind of clients that will buy a property on a group basis will be people who have got things in common. So typically, we see husband and wives or partners. We will see business directors and their spouses, or people that might run certain businesses together, coming together to combine their pension schemes to give them great purchase power to then go and buy a property, or maybe keep it in line with the ownership structure of their business, which is separate to the SIPP. So each individual client will set up their own SIPP. So example of Mr. and Mrs., they'll set up their own SIPPs here. And then what we will do is bring the monies into those individual SIPPs, either contributions or transfers, and then we will create a group SIPP that sits above that. So we'll funnel the money from the individual SIPs up into the group SIPP, and then it is the group SIPP then buys and holds the commercial property. And so that commercial property will be held in there, and the rent would come into the group SIPP and then get funneled down to each individual SIPP on a monthly or quarterly basis, however often the rent comes in. So if it's on a 50-50 split and it's £2,000 a month, £1,000 comes out of the group SIPP arrangement and goes into the into SIPP 1 and then SIPP 2 in that instance. So fairly straightforward, and we wouldn't charge any more for that group SIPP arrangement as well, which is why IPM are a bit more cost effective when it comes to things like this. As well as people with common interests as well, what we have seen over the years is actually that when people don't have sufficient funding within their SIPs, obviously you're limited the amount of money you can put into a SIPP. So where people are restricted in what they can put in and what they can use, instead of maybe thinking, right, should I put a further contribution in, or maybe I need to go and get borrowing? Say for example, client wants to buy a £200,000 property, but the client only has £180,000 in their pension. Do you want to lump £20,000 as a contribution in there? No bank's really going to give you a loan for £20,000. So the financial advisors have looked and seen what the client's spouse has got in terms of pensions, and maybe this is when I speak with advisors, but quite often when we speak with advisors, they'll say clients often forget they've got an old £40,000 old workplace Aviva pension sitting somewhere. So all of a sudden, by bringing the spouse into it and using any pension benefits they may have and creating a group SIPP arrangement, you help fill that funding gap that otherwise that individual client may have. So group SIPP absolutely for people with common interests, but also as well, when there's a lack of funding, always look at the people around the client to see if anyone can assist there. Coming back off the land situation, we own this fishing lake within the pension scheme, and I really like putting this one in the presentation because it is not typical to the other properties that we talk about. This thing is just a big old plot of land with a lake in the middle. The client involved, we've had this one for over 10 years now, and the client involved was in the fishing industry. He had an opportunity to buy this lake up in Scotland. He didn't have enough money in his business to do it outright, but he had enough in his pension fund, so his client set up his SIPP with us. And so we took a look at this. Now we're talking about commerciality. This was a clear one for commerciality for us. We had fewer concerns on this land purchase than we would do normally. The client's business was a long-term registered business. It had other lakes from which they ran their business from, so people would be paying money to come onto the lake and fish in the lakes, etc. It had good turnover, etc. So from a commercial perspective, we were fine with that. It clearly had access. It was nowhere near where the client lived. It was a genuine commercial investment for the pension scheme. So what this guy does, he bought this within his pension fund, so he's now got this asset sitting in his SIPP. Capital gains tax free, and he comes to sell it. He then pays rent to the SIPP for use of the land, so it comes out of his business, corporation tax free, comes into his SIPP, income tax free, and as I say, people come on to the land and fish in his lake. Caution absolutely around land purchases, but not a no by any stretch of imagination, as I say. But this gentleman with the fishing lake is a good example of ones that we're more likely to be comfortable with. More traditionally, compared to fishing lakes, we buy a lot of offices. And just very quickly, the reason for mentioning this is that this is meant to represent an office that we own for a group of accountants down in Essex. And around 9 or 10 of the partners set up SIPPs as we bought the entire property. And originally, they didn't need the entire building, but they still bought the entire property rather than split it into different titles and things like that. And they sublet part of the building. So the accountants are paying full rent for the pension scheme paying full rent to the pension scheme for full use of the property, whatever that may be. But actually they sublet the first floor for a couple of years on their own terms. And the subletting company then paid the rent to the accountants, which then helped them pay the rent to the pension scheme. So subletting is possible, but the reason we keep this in this presentation is because we've seen it the other way in recent years. Businesses downsizing, not needing enough room, but yet you still got to pay, if the money is owned within a SIPP, the full rent to the pension scheme for use of the building. So by inserting a subletting clause, it's potentially possible for the tenant to sublet part of that property to help generate the income to then pay rent to the pension fund. Coming down to the bottom left-hand side now, that is a pub. That is the Red Lion in Stansted Abbots in Hertfordshire. That is my local pub. They used to sponsor my football team, and they do one heck of a Sunday roast down there. But the reason for mentioning the Red Lion, because like most traditional pubs in the UK, you have the bar and restaurant on the ground floor, and then on the first floor, you've got a flat where the bar manager lives. Now, coming back to rule number 1 of SIPPs in property, buying residential property is normally a big no-no. You'll normally get a big tax charge if you own residential property within the SIPP. But there are times when the worlds collide a little bit. Take a pub in the first instance. There is a very quirky rule, or guideline, should I say, with HMRC, where it's something called the caretaker's clause. And that allows for someone who is not connected to the SIPP beneficiary, so not the client, spouse, children, anything like that, business partner, to live in the premises as long as it's a contractual obligation of their employment. So what that would mean with something like the Red Lion, for example, is if it's owned by a SIPP, and it's rented out to an unconnected third party, and they require a bar manager to live on site, it would be possible for the SIPP to own the entire Red Lion without getting that 40% tax charge. Similarly, if you're going to buy a shop, go down any high street and you look up on the first floor, you're most likely going to see a flat sitting above the shop. Now, it's unlikely in that instance that the SIPP is going to be able to acquire the whole thing, but it doesn't mean the SIPP can't help. You guys will be far more familiar with this terminology than me, but splitting the type of the property is where the SIPP can be involved. Now, we can't own residential property in any respect, not even a freehold residential ground rent. That is still a tax charge. So what we would like to see is that we would like to see the title split. So the SIPP acquires the leasehold interest of the ground floor shop or restaurant, whatever it may be. And then on the first floor, the freehold and the residential property is owned by someone else. And that can be a connected person. That could be the client personally or their business, but it can't be the SIPP. So from that perspective, it doesn't mean the SIPP can't buy the entire property, but it doesn't mean we can't get involved and help out. So again, it's just another reason to speak to the SIPP provider to see what solutions they can put to help you guys with. Coming on to the middle picture on the bottom, this industrial estate, this is just to kind of talk about someone who set up a SIPP with us originally when we were the old merchant bank back in '97, and he bought an industrial unit up in the northeast, and it was around £20,000 at the time. And over the years, he contributed more, he collected rent, and he ended up buying not 1 unit, not 2 units, he bought all 9 units on this industrial park within the Northeast. So now his SIPP at one point had 9 individual units sitting within the SIPP, all owned by the SIPP provider with all different tenants. Now, obviously buying more than one property is not going to be for everyone because properties are expensive and there's restrictions to how much you can get into pension schemes. Lack of liquidity and diversification, you know, we talked about those as negatives earlier. Well, this guy kind of nailed both of those. We talk about lack of liquidity. When he came to take his 25% tax-free lump sum, instead of having to sell one big property like the Red Lion pub, for example, he simply just sold 2 of the units. So instead of having 9, he now has 7. He's generated liquidity within his pension scheme. He gets paid out his 25% tax-free lump sum, and he's still got the other 7 units rented out, all paying rent in, which he's then taking as taxable income from his SIPP. In addition to that, in lack of diversification, yes, okay, he's still all fully invested in commercial property, but when one of his tenants went bust during COVID, actually, he didn't lose a full amount of rent from one tenant. He just lost one portion of rent from one tenant and still the other 6 paying him rent as well. So he mitigated that risk at that point. So yes, having more than one property is not going to be for everyone, but there can be some advantages of doing that as well. And just to kind of talk to you about other properties we've been approached to buy in the SIPP, or ones we do own, we've been asked to buy football stadiums, zoos, petrol stations, abattoirs, paintball centres, bowling alleys, anywhere where clients run a business and it can be deemed as commercial is something where SIPPs can be stepping in to help. So again, hopefully that's given you an idea of the kind of properties we bought and some of the stories behind it. I'm getting a little quicker now because I'm very conscious of time. I want to keep some time for questions, but I just generally want to talk about this screen and where we can help you. Because as I said, normally we would promote ourselves to financial advisors, but we do work with accountants, investment managers, solicitors, and as well, commercial property professionals like yourselves as well. So where is it that IPM can help you guys? What is it that we can do to add value to the work that you do? And I've listed just 3 here when I was preparing for this presentation. Hopefully at the end of this presentation, my contact details will be circulated around. And if you have any general SIPP related inquiries or queries, or just how does this work, or I've got a client with a property with XYZ and they're telling me one thing and I don't believe it, we're very happy to just provide that kind of level of support. You'll have my email address and phone number, and we can have a little chat about that and just see where we can help out, because again, very happy to share knowledge and help you where required. You may have clients who have properties with other SIPP or SaaS providers and are not happy. Transfers in specie of property from other SIPP providers is not the easiest thing to do. It's a bit of a bumpy ride and it costs a bit of money because you're changing the legal owner of the asset from IPM to whoever or vice versa. So actually, it is something that needs a lot of thought before you go ahead with it. We can help you with that. We can have a chat about that with you, and we can just make sure that your client goes into this kind of situation fully aware of the consequences. And obviously, any new property purchases in the SIPP, you might have a client that's talking to you about this, and you're looking for a SIPP provider to help. Obviously, we would welcome that opportunity and be very happy to help you. As I say, the majority of our business does come through financial advisors. So ideally, we'd work with the financial advisor on behalf of your client to make sure that the IPM SIPP is suitable, client aware of charges, etc. Because we can't provide advice. We can just provide factual information. We do have clients that approach directly. We have a mechanism for dealing with that. But as I say, ultimately, we would prefer introductions from financial advisors. But please don't let that put you off talking to us and seeing how best we can help if you do have a client that's looking at this area. Right. I feel like I've talked forever, and I can see I've been talking for 53 minutes already. I am going to leave that screen up there, which has all my contact details, and I've managed to even get a QR code for my LinkedIn. So if you want to connect on LinkedIn, then just get your camera and scan that. But I am now going to scoot over to the questions, that, if there are any, that Leslie has put into there. Okay, so there are a few. Let me just answer these quickly. Okay, I'm gonna take these ones that are here. If a children's care home has a residential manager and a contract with social services generating income, would that be a commercial property? So obviously without specifics, I cannot give a categorical answer to that, but we do own care homes within the scheme, and they're very similar to what that the person who asked that question has suggested. We have had one which hasn't, it mainly comes down to what the local authority deemed the property to be. If it's a commercial property paying commercial rates, and there's a commercial tenant in there who's paying rent for the pension scheme, then yes, absolutely, that can be deemed as a commercial property, and we could accept that within the scheme. But it is down to specifics. We did have one situation whereby we were told that we were buying something that was a care home. We can never be sure about these things until we get the SIPP set up and we instruct solicitors. Clients paid big employer contributions into the SIPP. You can't refund employer contributions. And as such, we couldn't buy the property and the money was trapped in the pension scheme. So it's always worth having these discussions, first of all, to make sure that's something that we can accept. HMOs, if they are subject to a single commercial lease to a company running the HMO, would that be deemed as a residential investment? This is coming back to the grey areas of HMRC and what is deemed as a residential property. Now, I can only talk from IPM's perspective as to what we will and won't accept. We will not accept a home of multiple occupancy under any circumstance, because for us, the clue's in the title. People are living there. Yes, you could argue that there is a commercial lease in place, so it could be deemed as commercial. The building might be deemed commercial itself, but ultimately what our job at IPM here is to protect the client's pension fund. So we're doing things in the best interest. So we would not accept HMO as an investment in the pension scheme, regardless of how that's packaged up or how that looks. But you may find other SIPP providers will be more, willing to take a look at that. Is that the right thing to do? I couldn't answer that, but as I say, it's down to each provider to set their own rules on that. The last question I'm going to answer here, because I appreciate we're coming up to the hour, and if you're anything like me, you probably want your lunch unless you've been eating while you've been watching. We undertake valuations for Barclays Bank and sometimes their SIPP team. Do you work with lenders, and what would be IPM's involvement? So we always try to, as a bit of a broader piece on this and answer that question, which may be helpful to you. We always try to give clients as much flexibility in terms of how they run the SIPP and the partners that they work with. So for things like surveyors, for example, we don't operate panels of surveyors clients can choose from. They can use anyone who's RICS chartered. Property managers, we don't have property managers clients must select from. They can appoint their own manager, a professional, or they can do it themselves in some instances. And with banks, we're the same. We don't tell people which banks they've got to go and work with. We're very happy for clients to go out, source the loan themselves, negotiate the terms, and then they come to us and go, right, IPM, we're going to borrow £100,000 from Barclays, paying interest at 6% of the arrangement fee of £1,000, or whatever that is going to be. So our involvement in it, as far as that's concerned, is you go and negotiate those terms for your clients or with your clients, and you come and tell us who you're working with, and then we will start working with that bank, because ultimately IPM as trustee, legal owner of property, is going to draw down that loan into the pension fund. Barclays are one of the better ones from my understanding. Big banks are starting to get a little bit better about understanding how SIPPs work. Barclays, Lloyds, Handelsbank, and NatWest, they tend to be the better ones because they have SIPP teams that understand how SIPPs work. And clients can also do connected lending as well, where they maybe lend from their company to their pension scheme. That's all an option on the table as well. So as I say, we don't try and restrict people to the parties that they work with. So we try and give them as much flexibility as possible. But ultimately, once the terms of the loan have been agreed, we would then take over and sign the loan deeds and all of that. Right, I think that has finished the questions. I haven't seen any more pop up, and we're coming up to almost 59 minutes now. So I just want to say a quick thank you again for taking the time to log on during lunchtime on a Thursday. Thank you for that. I hope you found the session interesting and you found some of the information provided to be beneficial in the work that you do. And yeah, just to emphasize again, please do get back in touch with IPM, or feel free to get in touch with me in any of the methods on the screen there. And I'll be very happy to help any member of the CPN out as and when required. So thanks very much, and I hope you enjoy the rest of your day.